Hello, my name is Matt Scott. A lot of people call me Pastor Matt, and then professionally, a lot of people call me the Money Guy. And I want to bring you just a quick 10 or 15 minute talk about money and family finances that is really the introduction to everything that I do. I am a public speaker. I do teach seminars about money in churches, schools, clubs, different organizations, and one-on-one. And this is the premise about what I do. And I'm going to do it from the spiritual side because there is a scripture that I use as the platform for this lesson. And it's Proverbs 13:22. If you've grown up in church at all or been in church at all, you've heard it. And basically it says that a good man leaves an inheritance for his children's children, and the wealth of the sinner is laid up for the just. Now, the second part, the wealth of the sinner is laid up for the just, is a very important topic, but it's not what we're going to dive into today. We're going to dive into that first part about being a good person, being a good man, being a good woman, and leaving an inheritance to your children's children. Now, a lot of times we hear that in church, and we hear that, and it's great teaching, it's true, but then there's a disconnect between what we know the Bible says we should do and then how do we actually do it. And that's what this talk is going to be about, is how to actually do that. And it's a lot easier than you might think, and it doesn't take a lot of money like a lot of people think. So first of all, let's break down what an inheritance is. An inheritance is nothing more than having a nest egg, an amount of money, some type of a possession that you can literally leave to people when you pass away. In today's time, we call that an estate, E-S-T-A-T-E, an estate. Estate simply means the liquid dollar value of your life, of everything that you own, whether it be real estate, land, savings accounts, checking accounts, life insurance. These are all part of what's called your estate. So the most practical way that you can leave an inheritance for your children's children is to make sure you have an estate, to make sure you have something of value. Now, let me give you a very depressing statistic. 90% of people at age 65 in America, and 90% of Americans at age 65 don't even have enough money to retire. They don't even have enough money personally to retire. Well, if you don't have enough money for yourself to retire at age 65, when you pass away, guess what you're leaving? Nothing. So the first step then would be, let's make sure you have something by the time it's time for you to retire. Because if you have nothing to retire on by the time you're 65 years of age, then you have nothing to leave behind. You can't obey Proverbs 13:22. So let's talk about how to get you there, okay? If you're taking notes, this is the way I would draw this out. There's two phases to your life. There's the early years and there's the later years. There's the early years and there's the later years. And somewhere in between the two is what I call debt-free money saved. Debt-free money saved. Most people I talk to know that they're supposed to be debt-free. Okay, we know the Bible says that. The borrower is servant to the lender. The Bible talks about getting out of debt as quickly as possible. So most people know they need to be debt-free, and most people know that they need to have money saved. But in the earlier years of life, when you've got a job and you're married and you have kids and you have a house mortgage and you have debt, you're not debt-free. Also in the early years, because you have all those bills and all those financial obligations, you don't have any money saved. So this becomes a problem. So how do you create an immediate estate in the early years when you have debt and when you don't have money? Like we said before, you have a house mortgage, you have car payments, you have electric bill, you have food, okay? You might have credit card debt, and you've got children, and children are not cheap. And that's about an 18 to 20 year debt, basically, having kids. It's an 18 to 20 year financial responsibility. Now, if the husband or the wife, or even in a situation, especially a situation of a single parent, if that income earner dies in the early years and there's tons of debt, not only is that going to cause emotional devastation, obviously, anytime someone passes, but now you've got severe financial devastation because there's no money saved to help pay for the mortgage, to help pay for food on the table, to help pay for the kids' schooling expenses, and on and on and on. And many people don't know this. When you pass away, the banks and the lenders don't just go, oh, well, you're dead, so we can't come after your debt anymore. We're going to forgive your debt. That's not what happens. They come after your family. So you are in danger in those early years of your life. Your family is in danger if you don't have enough money saved. I've got good news. The way that you create an immediate estate to protect the ones you love in the earlier years is life insurance. Now, that's the only purpose of life insurance, if you do it correctly. Because if you buy life insurance for the time period you need it, which is usually between the ages of 30 and 65, okay, that's the sweet spot of when you need life insurance, or it could be in your 20s to age 65, because that's when you have the mortgage, and that's when you have the kids, and that's when you have the debt, and you don't have the money saved yet. There's the sweet spot for buying life insurance. And if you buy life insurance for that amount of time, that's called term life insurance. And term life insurance gives you the most amount of coverage, so the biggest estate. And it gives it to you for the least amount of money per month, so the lowest price for the time period that you need it. And now if you're getting life insurance high coverage at a low price, guess what you can now do with that money that you're saving? You can put that away for your later years, because the later years are coming. So let's talk about that. You've passed the early years of life. Now you're in your mid 60s to early 70s. The house is paid off. The kids are out of the house. They're not an expense anymore. Your debts are paid down. So you don't really have people relying on your income anymore. And if you've done things correctly, which I'll show you how, you will have a retirement nest egg saved up. So now in the later years, your need for life insurance either diminishes significantly or you don't need it at all. Because let me ask you a question. If at age 65, you could choose only one, at age 65, you could choose only one, okay? Would you want to have $1 million saved tax-free for your retirement, or would you rather still be paying on $1 million life insurance policy? Well, common sense says you'd rather have the money, because money doubles as life insurance. So hear me on this. Money doubles as life insurance. If you have a retirement nest egg in the later years of your life and you pass away, that retirement account, that nest egg, that money has beneficiaries on it, just like life insurance. So if you pass away in the later years with money saved, you leave that money to whoever you want. So retirement money, nest egg, is life insurance. So the goal for everybody that I talk to is to help them in the early years start building that nest egg for retirement, so that one day they're self-insured. No one can put their thumb on them. They don't have to worry about borrowing money, loaning money, renting, all that kind of stuff. They don't have to worry about life insurance because they own the money. But better than life insurance, when you own the money, now you don't have to die to use it. Okay, so in the later years, you need a retirement plan. So that's how you use life insurance. That's how you use retirement planning. Now beware, there are companies that say, okay, you need life insurance, you need to save money for retirement, we're going to put that in one product. Bad idea. When you bundle your life insurance and your savings together, you're going to lose. Dave Ramsey and several other financial experts recommend something called buy term and invest the difference. Because a term life insurance policy gives you the most death benefit for the least amount of money for the time period you need it, you then can pay a much lower fee per month for your life insurance, so you can afford to put more money away into a retirement plan. So briefly, let's talk about whole life insurance, because this bundled product is called whole life cash value insurance. It has a lot of names. They've changed the name to universal life, variable life, and these are all variations of whole life insurance policies. Here's the essential way that they work. You're paying a higher monthly premium per month for a whole life policy. That money that you're paying is going to two places, okay? It's going toward the life insurance, and it's going toward the savings account inside the life insurance policy. One problem starting off is that what you're paying per month, they don't tell you how much of what you're paying is actually going towards the life insurance and how much of what you're paying is actually going towards the savings account. Now, I don't know about you, but if I'm saving money in an account and they're not telling me how much of my money they're putting in the account, that's crooked. I'm not going to do that. So that to me is a problem. Secondly, this savings account over here, for the national average 3 to 8 years, there's no money in that savings account. So if you need money out of that savings account, there's no money in it for 3 to 8 years. It's $0. The life insurance company is just taking your money, and it's not for your benefit. After that 3 to 8 year waiting period, you eventually start earning interest, usually 1, 2, or 3%. Well, that's not terrible, but you can make 1, 2, and 3% in other places and not have to wait 3 to 8 years to get it, and not have to not know how much of your money is actually going in there. But it gets worse. So you're building that interest rate in that savings account. You've waited your 3 to 8 years. Now you need some money out of there. You have an emergency. People tell me, yeah, but at least with my whole life, Matt, when I have an emergency, I can take money out. Actually, no. You have to fill out loan paperwork to get your own money that you put in out, and the national average interest rate that they're going to charge you, penalize you to touch your own money, which is absurd, is about 8%. And this 8% does not go back to you. It goes to the life insurance company. So you're spending 8% to borrow your own money. And if you don't pay it back, they subtract what you borrowed plus the penalty off of what your family gets if you die, even though you paid more money for both things. Crazy. And last but not least, I've kind of already said it, you can't have both. You've paid for two things, life insurance, cash value, but you can't have both things. So when you die, your family could get the life insurance, but whatever's in this cash value disappears. You don't get it. On the other hand, if you borrow all the cash value and you die without paying it back, life insurance disappears. So why pay a lot of money for two things when you only have one or the other? Whereas with a term life insurance policy and having a actual savings account separate, not the same product, a life insurance policy over here and a savings account over here, such as an IRA, an individual retirement account. If you pass away with a term policy and a separate IRA, individual retirement account, your family gets both things. Your family gets the life insurance policy plus whatever the IRA has grown to. They get both things instead of one or the other. So that's automatically better. And then secondly, eventually your retirement plan is going to grow to become worth more than your life insurance policy. And now when your retirement plan, and if it's a Roth IRA, it's tax-free money. When that tax-free nest egg now becomes worth more than your life insurance, and the house is paid off, and the kids are out of the house, guess what? Get rid of the life insurance. You don't need it anymore. It's a big lie that you need life insurance your entire life. If you've done things correctly, you're going to have money and you'll not need life insurance. Now, last but not least, let's talk about retirement for just a second. In America, you only have 3 legal options for retirement. You've got Social Security, and here's the way I picture it. When you retire, you're older, you're tired, you want to sit down, you want to rest. So you want to pull up a stool to sit on. Now, most stools have at least 3 legs, because a stool with 3 legs you can sit on. Well, most people have 3 options for retirement in America. The first option, the first leg to that stool that you want to sit on, is the one the government gives you, called Social Security. Now, Social Security, if you didn't know, is owned by the government, which means there's no guarantees there, and Social Security is not going to pay you enough money to live when you retire. So how would you feel about having 100% of your retirement hopes and dreams on Social Security? Hopefully you're not cool with that. The second, we've got Social Security. The second leg to your retirement stool would be like a 401k, something through your job. Now, this is not bad. I am for 401ks. If your company offers you a 401k, find out what they will match and put in what they will match, at least, because that's free money. But still, 401k is owned somewhat by your job. So if you don't work there long enough, you can't have one. And once you have one, if you don't have it for long enough and you quit or get fired, they can take money out of your 401k. Not saying it's a bad thing, it's just still you don't own it. Then the third option is an IRA, an individual retirement account. An individual means you as the individual own it. It's the only one that 100% you own that money. And with a Roth IRA, when you get ready to retire, as long as it's after age 59 and a half years old, 100% of the money in the Roth IRA is tax-free. And in that IRA, you can have investments. And one of my jobs is to recommend the right investments for you that can earn you very high interest rates so you can build that nest egg. And then once you retire, you're going to go to something more, a guaranteed interest rate, to protect that nest egg and make sure that no matter what happens to the stock market, you're not going to lose money. So in essence, early years of life, later years of life. A life insurance policy, a term life insurance policy, is the perfect tool to protect your family in that early year period. But then you can start saving money at the same time so that eventually your Roth IRA becomes worth more than your life insurance, and the kids are gone, and the debts are paid off, and the mortgage is paid, and now you're self-insured with your retirement plan that still counts as a life insurance policy if you were to pass away. This is the most cost-effective, the best way to do it. This is absolutely, bar none, the best way to do it. And I wanted to give you that information on that. If you'd like to learn more details on what life insurance costs and more details of how it works, or the same thing with the retirement, that is what I do professionally. But if you don't use me, find someone you trust that'll help you buy term and invest the difference. I hope this helped out, and maybe we'll be blessed to meet each other soon. Have a great day.